Hello guys, let's talk about quantitative easing today. It has been in use for quite some time. So it's a monetary policy whereby central banks purchase government bonds and other fixed income assets in order to inject money into the economy in order to expand economic activity. Quantitative easing is an unconventional form of monetary policy which is used when the inflation numbers are quite low and other monetary policy instruments become ineffective. On the other hand, quantitative tightening is just opposite, where government focuses on targeting inflation numbers and trying to squeeze money from the from the market by reducing the monetary supply, by selling out fixed income instruments which includes bonds, mortgage backed securities and other assets. Recently, Fed has tapered asset purchases, followed by starting of quantitative tightening policies in order to reduce its bubbled up balance sheet of around $9 trillion. So, the tapering of Fed's asset purchase program was the first step towards normalizing its ultra loose monetary policies, which started in the COVID time when the government bailed out when the government provided bailed out packages to big businesses so that they can survive. After completing the tapering process, Fed would initiate the policy rate hikes. After that, the Fed would begin reducing the size of its balance sheet, a process that we call quantitative tightening. So, for your knowledge, the tapering process began in December 2021. So, what would be the impact of quantitative tightening on emerging market, which is done by Fed? So, firstly, an aggressive financial tightening would raise the US yield and strengthen the US dollar against emerging market currencies. As a result, portfolio flows would abruptly reverse. The US based global investors or the developed market investors would pull their money out of the emerging market and invest in other developed economies, or what we call safe haven US assets. As the Fed sets the tone for global monetary policies, other systematically important central banks will follow the same suit, and due to which, in response to faster rate hikes by Fed, the emerging market economies central bank would have to raise interest rate in order to maintain the interest rate differentials, in order to prevent capital outflows and domestic currency depreciation, despite their sluggish recovery and growth risk. Yeah, indeed, that tighter monetary policy by the US and other advanced economy present dilemmas for the policymakers in other economies, especially emerging markets, because if central banks in emerging market continue the current loose monetary policy with ultra low interest rates, it will lead to capital outflow and domestic currency depreciation. On the other hand, if emerging market central bank pursue tighter monetary policy by increasing interest rate too early, then it might derail their fragile domestic economic growth. Hence, both options risk undermining the economic recovery process. Only those emerging markets that actively manage capital accounts like India can pursue some degree of monetary autonomy. So that was all for today. We will come with some different topic related to macroeconomic, and till then, goodbye, see you, take care.